I want you to think about what happens when a market stops behaving the way people expect it to behave. That is the moment when most people either become overconfident or frightened. They usually do not become thoughtful. They either chase what is moving or they sell what scares them. And that is why cycles repeat. The names change, the headlines change, the central bankers change, the technology changes, but human behavior changes very little. Right now, we are watching one of those moments. The stock market has been moving with extraordinary strength. We have seen a powerful rally. We have seen prices come back near record highs. We have seen risk assets recover faster than many people believed was possible. Bitcoin has rebounded. Housing activity has shown signs of life in some areas. Financial assets are moving as if the future is improving before the average person feels any improvement in the present. That gap is very important. When asset prices rise while the average household feels worse, you are not looking at a normal environment. You are looking at a split economy. You are looking at Wall Street discounting tomorrow, while Main Street is living through today. You are looking at a system where liquidity, expectations, inflation, interest rates, oil prices, and psychology are all pushing against each other at the same time. Most investors do not know how to think in that kind of environment. They want one clean answer. They want somebody to say the market will go up or the market will go down. They want a forecast that removes uncertainty. But markets do not reward the people who need certainty. Markets reward the people who understand probabilities, cycles, and positioning. The important thing is not to ask, is this good or bad? The important thing is to ask, what is happening mechanically? What are the forces, who benefits, who gets hurt, where is the pressure building, and how should I position myself so that I do not need to be exactly right about the next headline? That is how I think about this moment. The Federal Reserve has effectively told the market that rate cuts are not coming the way many investors expected them to come. That is not a small detail. It changes the discount rate, it changes mortgage rates, it changes borrowing costs, it changes the psychology of risk. But the strange thing is that the market has not broken under that message. It has moved higher. That tells you something. It does not tell you that everything is healthy. It does not tell you that inflation is solved. It does not tell you that consumers are fine. It tells you that markets are not simple mirrors of today's pain. They are discounting mechanisms. They look forward. Sometimes they are wrong, and sometimes they are very wrong, but they are always trying to price what comes next. And what comes next is not obvious. Oil is one of the biggest variables in this whole system. Most people think of oil only when they fill up their car. They see the price at the pump and they get annoyed. But oil is not just gasoline. Oil is embedded in the cost structure of the entire economy. It moves trucks, it moves ships, it moves planes. It helps make plastics. It affects fertilizers. It affects packaging. It affects food distribution. It affects manufacturing. It affects almost every physical good that must be produced, moved, stored, or delivered. When oil rises sharply, it is not a small input shock. It is a system shock. If crude oil rises by a meaningful amount, inflation pressure comes back into the economy through the supply chain. That is why oil matters so much to the Federal Reserve. The Fed can influence demand by raising or lowering interest rates, but it cannot pump oil out of the ground. It cannot control geopolitics. It cannot prevent supply shocks. It cannot make a cargo ship cheaper to run by holding a press conference. So when oil rises, the Fed faces a difficult trade-off. If the economy weakens, the usual instinct is to cut rates. But if inflation is rising because energy costs are rising, cutting rates can make the inflation problem worse. If the Fed does not cut, then borrowers remain under pressure, consumers remain squeezed, and businesses face higher financing costs. This is how stagflationary pressure begins. Growth softens, but inflation does not disappear. This is the environment that confuses most people. They think weak consumer sentiment should mean weak stocks. They think no rate cuts should mean markets must fall. They think higher oil should mean investors must immediately panic. But markets do not move in straight lines, because markets are not moral machines. They do not reward what feels fair. They price liquidity, earnings expectations, positioning, policy reactions, and future probabilities. That is why you can have a miserable consumer and a rising stock market at the same time. Consumer sentiment reflects how people feel right now. It reflects grocery bills, gas prices, rent, mortgage payments, job anxiety, and the stress of everyday living. The stock market is looking at earnings, future policy, margins, artificial intelligence, productivity, corporate power, and what large pools of capital think will happen 12 months from now. Those two worlds can separate for a long time. This is one of the great misunderstandings in investing. People assume that because the average household feels pain, the market must immediately fall. Sometimes it does, but sometimes the pain itself becomes part of the setup. When sentiment is extremely low, when people are discouraged, when people are convinced that nothing works, that can be when prices have already absorbed a lot of fear. That does not mean you blindly buy everything. It means you respect how cycles work. In my experience, the biggest mistakes happen when people confuse emotion with signal. Fear feels intelligent when prices are falling. Greed feels justified when prices are rising. But both are just emotions, unless they are tied to a system. What we have just seen is one of the strongest short-term market recoveries in recent memory. The market moved from oversold to overbought very quickly. The Nasdaq had a long winning streak. The SP recovered strongly. Bitcoin bounced hard. People who sold at the bottom because they wanted clarity watched the market move without them. That is one of the cruelest parts of markets. Clarity usually arrives after the price has already moved. When people say, "I will wait until things are certain," what they usually mean is, "I will wait until the opportunity is gone and the crowd feels comfortable again." But when the crowd feels comfortable, prices usually reflect that comfort. The discount is gone. The fear premium is gone. The asymmetry is gone. That is why I do not build my life around market timing. I have seen too many cycles. I have seen too many smart people become convinced that they know what will happen next, and I have seen the market humble them again and again. You can analyze everything correctly and still lose money if the timing, positioning, or policy response moves against you. You can understand inflation, oil, the Fed, earnings, housing, and geopolitics. And then one statement, one data point, one geopolitical shock, or one policy turn can change the entire path. That is not a reason to give up. It is a reason to build a system that does not require you to be a prophet. The way I think about investing is simple, but not easy. I want to own assets that can compound over long periods. I want to diversify enough that one mistake does not destroy me. I want to rebalance when things become extreme. I want to keep enough liquidity that I am not forced to sell at the wrong time. And I want to keep investing through uncertainty because uncertainty is the normal condition. Most people do the opposite. They are confident when prices are high. They are terrified when prices are low. They talk about long-term investing until a drawdown happens, and then they become short-term traders at the worst possible moment. They want the returns of ownership without the pain of ownership. That is not how compounding works. Compounding is the reward for staying in the game through difficult periods without blowing yourself up. This is especially true in an environment where the Fed is not giving investors the easy path they expected. Many people believed rate cuts would come quickly. They built expectations around that. They assumed cheaper money would support stocks, housing, and risk assets. But inflation has not disappeared in a clean way, and oil has added another complication. When rate cuts get pushed further into the future, that normally tightens financial conditions. Mortgages stay expensive. Auto loans stay expensive. Credit card debt stays expensive. Business financing stays expensive. Housing affordability remains weak. Consumers feel the pressure. Yet markets can still rise if investors believe future earnings, future liquidity, or future productivity will offset that pressure. That is why this moment feels so strange. It is not one force moving in one direction. It is multiple forces colliding. On one side, there is inflation pressure from oil and supply costs. There is consumer weakness. There are high borrowing costs. There are housing affordability problems. There is a fragile labor market. On the other side, there is corporate resilience. There is artificial intelligence optimism. There are large companies with pricing power. There is liquidity looking for a home. There are investors who believe that any slowdown will eventually force policy support. That combination can create what people call a melt. A melt-up is not the same thing as a healthy expansion. It is a rapid rise in asset prices driven by positioning, momentum, liquidity, and the fear of missing out. It often happens late in a cycle, when people who were cautious start feeling forced to participate. Prices move because people are not positioned for prices to move. Then the move itself creates more buying. That is powerful, but it can also be dangerous. A melt-up can make people feel brilliant right before the environment becomes fragile. It can make valuation stop mattering for a while. It can make skeptics look foolish. It can make ordinary investors take risks they do not understand because they see other people getting rich faster. You have to be very careful in that kind of phase. The correct response is not to panic and sell everything. The correct response is also not to abandon discipline and chase everything. The correct response is to know what you own, why you own it, what role it plays, and what size it should be in your portfolio. That is the principle. If you own stocks because you believe productive companies will compound earnings over time, then short-term volatility is part of the deal. If you own Bitcoin because you believe it is a scarce, volatile, alternative monetary asset that can play a role in a diversified portfolio, then you should size it so that a large drawdown does not emotionally destroy you. If you own real estate, you need to understand rates, local supply, affordability, insurance costs, and your time horizon. Every asset has a role. Every asset has risk. The mistake is treating any asset like magic. Bitcoin is a good example of this. It has recovered strongly after a painful decline. Institutional money has continued to flow into Bitcoin-related products. Large financial firms are building crypto offerings. The national debt keeps rising. Many people are looking for ways to hedge against currency debasement and monetary disorder. Those are real forces. But Bitcoin is still volatile. It can fall sharply. It can create enormous psychological stress for people who size it too large. It can make people feel like geniuses on the way up and failures on the way down. That is why the question is never just, do I believe in this asset? The question is, how much can I own and still behave rationally if it falls 30, 40, or 50%? That is the right question. If an asset can make you sell at the bottom because you were overexposed, then you did not own an investment. You owned a behavioral problem. The same principle applies to housing. Housing is not one market. It is thousands of local markets. Some areas are still tight. Some areas are softening. Some areas had enormous run-ups and are now facing affordability limits. Some regions have inventory building. Some sellers are starting to cut prices because buyers no longer feel urgency. Mortgage rates are the key variable. Higher oil can feed inflation expectations. Higher inflation expectations can keep rates elevated. Higher rates reduce affordability. Lower affordability reduces buyer demand. If buyer demand weakens and inventory rises, prices can soften even if the national average looks stable. This is why broad housing headlines are often not useful. A national forecast can say home prices are flat, but that hides enormous dispersion. Some markets can rise, some markets can fall, some can be frozen because sellers with low mortgage rates refuse to move and buyers with high rates cannot afford to buy. In that environment, patience matters. If you are buying a house to live in for a long time and the payment fits your life, that is a different decision than speculating on short-term appreciation. If you are buying an investment property, the math must work without relying on rapid price increases. If the numbers only work because you assume rates will fall and prices will rise, then you are not investing. You are hoping. Hope is not a strategy. What matters is cash flow, affordability, reserves, and time horizon. It matters whether you can hold through a bad period. It matters whether the asset can carry itself. It matters whether you understand your local market better than the person selling you optimism. The Fed does not solve those problems for you. A lot of people focus too much on who runs the Federal Reserve. They believe one person will change everything. The chair matters, but the system is bigger than one person. The Fed is constrained by inflation, employment, financial stability, political pressure, and market expectations. A new chair may influence the path, but no Fed chair can repeal the cycle. If inflation is sticky, the Fed has less freedom. If the economy weakens sharply, the Fed gains pressure to ease. If oil shocks the system, the trade-off becomes harder. If markets rise too far too fast, financial conditions can loosen in a way that fights the Fed's objective. This is a balancing act, not a clean plan. That is why I do not want to base my entire financial life on guessing the next speech, the next meeting, or the next rate cut. I want to know the environment, but I do not want to be controlled by it. The more uncertain the world becomes, the more important it is to have principles. A good principle is this: do not stop investing because the headlines are uncomfortable. Another is this: do not invest so aggressively that a normal drawdown forces you to stop. Another is this: diversify across assets that respond differently to different environments. Another is this: keep enough cash for resilience, but do not confuse cash with long-term wealth. Another is this: never make a portfolio decision because the market made you feel embarrassed. That last one is especially important in melt-up environments. When assets rise quickly, people who were cautious begin to feel stupid. They feel like everyone else understood something they missed. They start looking backward and imagining how much money they would have made if they had bought the bottom. That feeling can become very dangerous because it pushes them to buy, not because the decision is rational, but because they want to erase the pain of missing out. That is not investing. That is emotional repair. Markets exploit emotional repair. They push people into risk after the reward has already been partly captured. Then, when the reversal comes, those same people do not have conviction. They only have regret. The way to avoid that is to have a repeatable system before the emotion arrives. For most people, that system is not complicated. Decide how much of your income you can invest each month. Decide what allocation fits your risk tolerance. Use broad, low-cost vehicles for the core. Add smaller satellite positions only if you understand them and can tolerate their volatility. Rebalance when things become distorted. Keep investing through cycles. Do not allow headlines to become your strategy. That sounds simple, but it is very difficult because human beings are not wired for it. We are wired to extrapolate. When prices go up, we think they will keep going up. When prices go down, we think they will keep going down. When the news is frightening, we think safety means doing nothing. When the news is euphoric, we think risk has disappeared. Both assumptions are wrong. Risk is not highest when people feel afraid. Risk is often highest when people feel invincible. Opportunity is not greatest when the path looks clear. Opportunity is often greatest when the path looks uncertain. But the long-term fundamentals remain intact. This is why I say the market is always teaching. The question is whether you are learning or just reacting. Look at the recent rally. Many people sold when the market looked terrible. They waited for clarity. Then the market moved hard and fast. Now they are facing a new emotional problem. Do they chase? Do they stay out? Do they admit they were wrong? Do they rebuild a plan? The best answer is not to chase the exact move you missed. The best answer is to stop building your process around fear and regret. If your long-term plan required you to be invested, then rebuild the plan and follow it. If your allocation was too aggressive, and that is why you sold, reduce the risk to a level you can actually hold. If you had no liquidity and panic came from needing cash, build a better cash reserve. If you were buying assets you did not understand, simplify. Every mistake contains a principle if you are willing to look at it honestly. The same applies to Bitcoin. If you bought only because others were euphoric, you probably sold when they became fearful. If you bought because you had a defined allocation and a long-term view, the drawdown may have been painful but not fatal. That is the difference between speculation and structured risk. The same applies to housing. If you bought because you believe prices always go up, higher rates may have exposed the weakness in your thinking. If you bought because the payment was manageable, the time horizon was long, and the asset fit your life, short-term price weakness may not matter very much. The same applies to stocks. If you bought because you thought the Fed would cut rates on your schedule, you may be confused now. If you bought because productive assets tend to rise over long periods as earnings grow, then you understand that the path is never smooth. The market is not there to validate your calendar. It is there to transfer money from the impatient to the disciplined. This is why I do not obsess over whether the next rate cut happens this year, next year, or later. Of course it matters for markets. Of course it matters for mortgage rates. Of course it matters for valuations. But my core system cannot depend on getting that exactly right. If rates stay high longer, some assets struggle and savers earn more in short-term instruments. If rates fall, long-duration assets may benefit and cash yields decline. If inflation stays sticky, hard assets and companies with pricing power may matter more. If growth slows, quality balance sheets and durable cash flows matter more. Different environments reward different things. The way to survive all of them is not to guess one scenario with total confidence. It is to build a portfolio that can handle multiple scenarios. That is the essence of good risk management. Many investors think risk management means avoiding risk. It does not. If you avoid all risk, inflation eats you. Opportunity passes you. Time works against idle money. Real risk management means taking the risks you are paid to take, avoiding the ones you are not paid to take, and sizing positions so that you can stay in the game. You cannot compound if you are forced out. The Fed pausing rate cuts does not mean the investment world ends. A melt-up does not mean the investment world is safe. Oil rising does not mean everything must collapse. Bitcoin recovering does not mean volatility is gone. Housing softening does not mean every property is bad. These are all pieces in a larger machine. The job is to understand the machine. When oil rises, watch inflation expectations. When inflation expectations rise, watch the Fed. When the Fed holds rates higher, watch credit, housing, consumers, and small business. When markets rise despite all of that, watch positioning and liquidity. When sentiment is terrible and prices rise, understand that Wall Street and Main Street may be in different phases of the cycle. That is the map. But the map is not the territory. The territory changes. That is why humility matters. Anyone who tells you they know exactly what happens next is either selling certainty or suffering from it. I prefer to think in ranges. There is a range of outcomes where inflation stays hot and rates remain high. There is a range where growth weakens and the Fed eventually cuts. There is a range where markets melt up further before correcting. There is a range where the rally broadens. There is a range where leadership narrows. There is a range where Bitcoin continues to attract institutional flows. There is a range where it has another deep drawdown. There is a range where housing stays frozen rather than crashes. If you understand ranges, you stop needing one perfect answer. That is how I want you to think. Now, do not look at this market and say, "This makes no sense." Markets often do things that seem to make no sense when you are watching only one variable. Instead, say, "What variables am I missing?" Maybe you are watching inflation while institutions are watching future earnings. Maybe you are watching consumer pain while traders are watching liquidity. Maybe you are watching mortgage rates while buyers are watching inventory. Maybe you are watching Bitcoin volatility while institutions are watching long-term allocation demand. The world is always more complex than one headline, but complexity does not mean paralysis. It means you need principles. Here is the principle I would keep closest right now. Stay consistent, but do not be blind. Keep investing, but understand your risk. Hold cash for emergencies, but do not let fear turn your whole life into cash. Own productive assets, but do not chase them without discipline. Respect Bitcoin if it fits your system, but do not let it dominate your psychology. Approach housing with local math, not national headlines. Listen to the Fed, but do not outsource your future to the Fed. That is how you stop being jerked around by every headline. The great danger of this phase is not only that prices may fall, the danger is that prices may rise enough to convince people that discipline is unnecessary. That is how cycles usually trap people near the end. They punish caution for a while, reward excess for a while, and then reveal who had a real system. A good system feels boring during a melt-up because it prevents you from doing the most exciting thing. It also saves you during the reversal because it prevents you from doing the most destructive thing. That is why boring is powerful. If you had invested consistently through the fear, you did not need to predict the rally. If you had maintained an allocation to risk assets, you participated. If you had kept Bitcoin sized properly, you could buy weakness without losing your mind. If you had avoided over-leveraging into housing, you did not need prices to rise immediately to survive. If you had kept your expenses under control, you had flexibility while others were forced to react. Flexibility is one of the most valuable assets in any cycle. Cash gives you short-term flexibility. Diversification gives you portfolio flexibility. Low debt gives you life flexibility. Skill development gives you income flexibility. Emotional discipline gives you decision-making flexibility. The mistake is to think one asset alone gives you all of that. It does not. The system is bigger than one asset. That is why I always come back to balance. In a world where inflation can surprise, own assets that can respond to inflation. In a world where markets can crash, keep liquidity and avoid excessive leverage. In a world where policy can change quickly, do not rely on one forecast. In a world where technology can create enormous wealth, own enough innovation to benefit. In a world where innovation can become a bubble, do not bet your survival on it. That is the balance. The current market is telling us that investors are willing to look through today's discomfort and price a better future. It may be right, it may be wrong, but either way, your job is not to predict every turn. Your job is to avoid being forced into bad decisions by fear, greed, leverage, or lack of preparation. That is what most people miss. They think the question is whether this is the beginning of a generational melt-up or the final phase before a painful correction. It could be either. It could even be both. Markets can rise much further than reasonable people think and then fall much faster than comfortable people expect. That is why the real question is not, what will the market do? The real question is, what will I do if the market does something I did not expect? If you can answer that before the event, you are prepared. If you wait until the event, you are emotional. So this is where I would leave you. We are in an unusual environment. Oil is pressuring inflation. The Fed is not eager to cut. Consumers feel bad. Stocks are near highs. Bitcoin is recovering. Housing is fragmented. Policy leadership is changing. Expectations are unstable. That is not a clean environment. It is a complex one. In complex environments, you do not need more noise. You need better principles. You need a plan for how much to invest. You need an allocation you can actually hold. You need to accept that drawdowns are part of the process. You need to understand that clarity is expensive. You need to stop letting headlines determine your behavior, and you need to remember that wealth is usually built by people who can stay rational while others are oscillating between panic and euphoria. That is the game. It is not about being the smartest person in the room. It is about not being the person who gets pulled out of position by every emotional wave. It is about understanding that markets can move higher when people feel terrible and lower when people feel safe. It is about knowing that the economy and the market are related, but they are not the same thing. It is about realizing that the Fed matters, but your behavior matters more. The market may melt up, it may correct, it may do both. But if you have a sound system, you do not need the next move to save. You keep adjusting, you keep your risk at a level that allows you to sleep. You own assets because the world keeps producing, innovating, adapting, and growing over long periods. Even though the path is always uncertain, that is how you come out ahead. Not by predicting every Fed decision, not by guessing every oil shock, not by chasing every rally, not by selling every panic. You come out ahead by building a durable system before the world tests you, and the world always tests you.